What drives your investment choices? Today, we dive into the fascinating comparison of SCHG versus JEPI. SCHG, with its focus on growth, offers a modest dividend yield of 0.4% and an exceptionally low expense ratio of 0.04%. On the other hand, JEPI stands out with a high dividend yield of 7.52%, though it carries a higher expense ratio of 0.35%. Understanding these fundamental aspects is crucial for making informed decisions. Dividend yield often captures an investor's eye. Let's compare SCHG and JEPI. When diving into the world of investments, the term dividend yield frequently pops up. Essentially, it's a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Higher yields are often attractive because they suggest more bang for your buck in terms of income generated from your investments. Now, looking at SCHG, the dividend yield sits at a modest 0.4%. This might seem low, but it's typical for funds that focus more on capital growth rather than income. On the flip side, JEPI paints a different picture with a dividend yield of 7.52%, which is considerably higher. This makes JEPI a potentially appealing option for those seeking regular income from their investments. However, a higher dividend yield can sometimes indicate higher risks or that the market believes the stock price might decline. While JEPI offers a tempting higher yield, let's see how the cost of owning these funds compares next. Every investor keeps an eye on costs. Now, examine the expense ratios of SCHG versus JEPI. When it comes to managing investments, the expense ratio can be a silent budget drainer. SCHG boasts a remarkably low expense ratio of 0.04%, making it a lean choice for those who prioritize cost efficiency. On the other hand, JEPI's expense ratio stands at 0.35%. While higher, it's crucial to delve deeper to understand the impact of these costs. The expense ratio is essentially the annual fee charged by the fund to manage your investments. It covers operational costs, management fees, and other administrative expenses. Even a small difference, like the one between SCHG and JEPI, can significantly affect the total returns over time. For instance, a higher expense ratio can eat into the profits from a fund's returns, making it less lucrative in the long run. Lower costs or higher yields? The decision isn't always straightforward. Next, we evaluate their performance. Performance metrics can reveal the true strength of an investment. Let's dissect the numbers. Diving into the annualized return, SCHG boasts an impressive 12.49%. This figure significantly outpaces JEPI, which has a more modest 9.44% return. Clearly, SCHG leads in the race for growth, but it's not all about the speed of ascent. Now let's talk about volatility. SCHG's standard deviation stands at 21.21%. This is nearly double that of JEPI, which records a more conservative 11.22%. This lower volatility suggests that JEPI offers a smoother investment journey compared to the rollercoaster ride with SCHG. Examining the best and worst years provides further insights. SCHG's best year saw a staggering 50.11% return, while its worst year dipped to minus 31.80%. In contrast, JEPI's peak performance was 21.51%, with the lowest drop being just minus 3.53%. This stark difference highlights JEPI's ability to provide steadier, albeit lower, returns. The maximum drawdown further underscores this stability. SCHG experienced a maximum drawdown of minus 31.80%, indicating significant potential drops. JEPI, on the other hand, showed a maximum drawdown of only minus 12.99%, reinforcing its profile as a safer harbor during market turbulence. Understanding these metrics illuminates the risk and return profile of each fund. But how do they really stack up overall? Risk versus return is the eternal balancing act in investing. Let's dive into how SCHG and JEPI manage this balancing act, focusing on their Sharpe and Sortino ratios. The Sharpe ratio helps investors understand the return of an investment compared to its risk. SCHG's Sharpe ratio stands at 0.54, indicating moderate risk-adjusted returns. In contrast, JEPI presents a Sharpe ratio of 0.63, suggesting it might offer slightly better returns for the risk taken. Now, let's consider the Sortino ratio, which focuses only on the downside risk. SCHG has a Sortino ratio of 0.83, while JEPI leads with a ratio of 1.03. This higher Sortino ratio indicates that JEPI manages downside risks more efficiently than SCHG, which could be appealing for more risk-averse investors. Despite SCHG showing a higher annualized return, JEPI's superior risk management metrics suggest it might be a safer choice for those particularly sensitive to market downturns. Balancing risk and return is crucial. Let's summarize what we've uncovered about SCHG versus JEPI. Now that we've explored SCHG versus JEPI in depth, it's decision time. Diving into the dividend yields, SCHG offers a modest yield of 0.4%, which is significantly lower compared to JEPI's robust 7.52% yield. This stark contrast makes JEPI a tempting option for those seeking regular income streams. On the expense front, SCHG is notably leaner, with an expense ratio of just 0.04%, whereas JEPI's ratio stands at 0.35%. This makes SCHG a cost-effective choice, particularly appealing for cost-conscious investors. Performance metrics further delineate these funds. SCHG boasts a higher compound annual growth rate at 12.49% against JEPI's 9.44%, suggesting a stronger growth potential. However, JEPI offers a smoother ride with significantly lower volatility and a superior Sortino ratio, highlighting better downside protection. In summary, if steady income and lower risk are your priorities, JEPI might be your match. Conversely, for those chasing higher growth and can stomach more volatility, SCHG could be more enticing. Whether you seek stability with JEPI or growth with SCHG, your investment choice should align with your financial goals and risk tolerance. Happy investing! Remember to subscribe and comment on what fund you would like me to look into next.